I think that's the sort of $64,000 question here. And everything that I detect, all these features are basically lending themselves towards what I would call Treasury QE. And that is a much more directed form of liquidity stimulus that basically goes into the real economy and not, generally or in an undirected way to financial markets, lifting all asset prices, but creating big wealth anomalies in the economy.
QT is officially over, and it looks like the Fed will be adding liquidity in 2026. But how much, and will it be enough, or is this going to be another example of too little too late from Jerome Powell? Hello, and welcome to Milk Road Macro, the podcast that knows that there's nothing quite like the smell of liquidity in the morning. I'm your host, John Gillen. Today is Tuesday, December 9th, but we are going to be releasing this episode on the 25th, Christmas Day. Merry Christmas, everyone. And we are joined today by a very special guest, the godfather of global liquidity himself, Michael Howell. Michael is the founder and CEO of Cross Border Capital and the author of the Capital Wars book and Substack. He is recognized as one of the world's leading experts on global liquidity with over 30 years of experience in finance and macro analysis. Michael is always fantastic. I learn a lot from him every time we talk, and he's going to give us a crucial update on the liquidity outlook for 2026. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who's going to enjoy it. Today's episode is brought to you by Reserve DTFs. Get exposure to the entire crypto market in a single token. And without further ado, welcome to Milk Road Macro, or maybe I should say welcome back to Milk Road Macro. Michael Howell, how are you, sir?
I'm pretty good. Good to be here, John. Happy holidays, everybody. May not be a happy new year. That's the only problem.
Yeah, well, that's what I want to get some more information from you about in this conversation. And I thought a good place to start would be with the end of something, which is the end of quantitative tightening that happened at the 1st of December. And the Fed is now pivoting away from this tightening posture more towards what looks like an easing posture. And I want to get your thoughts on this. Has the Fed been behind the curve on ending quantitative tightening? Did they let this go too long? And what is your outlook in terms of how this will impact the liquidity situation?
Well, I mean, the first thing is that the Fed have been sort of pushed into this, really. I mean, there's obviously been a reluctance to start or to restart QE. We've had maybe step one, which is the ending of QT as of December 1. And I think by the time this episode goes out, there'll be a restart. And that will not be called QE. It'll be called something like reserve management purchases or whatever, something along those lines. That seems to be the line, the acronym that we're being fed at the moment. So RMP. So the question is, is the Federal Reserve RMPing the markets? And I think the answer is, given the scale that they're likely to inject liquidity, probably not. And that's really the debate. I mean, they've got a conduit now, a new conduit that they can use. But the real question is, will they use it? And I think the problem the hole they've dug is that the Treasury General Account, which is one of the elements on the Fed balance sheet. I mean, we are getting quickly into the weeds here, but it's one of the elements on the Fed balance sheet that fluctuates a lot and causes big disturbances in liquidity in the markets. That Treasury General Account is large, and it probably isn't going away. It's going to remain elevated. And one of the reasons it's staying elevated is, number one, there's a big federal deficit out there. And number two is a lot of that federal deficit is being funded at the very short end of the market through bills. So what that means is that the Treasury is coming to the markets every week with something like $500 to $600 billion of roll on the existing Treasury, refinancing maturing Treasuries. And that is a big, big ask. And given the fact that the Treasury likes to keep about 5 days cash flow needs in that Treasury General Account, with that big debt roll that is on us every week, they're going to have to keep a big, big reserve in the Fed, and hence the large TGA. So many people have been arguing that TGA drops. It doesn't. That's been the problem that we've seen recently. The TGA has been built up fairly significantly, particularly since the ending of the debt ceiling. And although the debt ceiling debate caused a lot of money to go into markets in the first half of the year, the resolution of the debt ceiling is now drawing it out again. And we're really starting with a low level of liquidity. So the Fed is deliberately pushing bank reserves by all these mechanisms below the critical threshold, which we put at about 3.3 trillion. We're now looking at numbers of 2.9 trillion for US bank reserves. So there's a big shortfall, 400 billion. And that's the shortfall we've got to make up with the new quantitative easing. And I don't think they're really they're not on the same page when it comes to volumes.
So I think I want to unpack this issue around the TGA a little bit, because I do think a lot of people have misunderstood this. Obviously, during the government shutdown, the Treasury General account wasn't being spent out of, and it filled up to, I think, a little over $1 trillion. Correct me if I'm wrong on that, but that was over their target. And now that the government shutdown has ended, I think a lot of people expected a wave of several billions, hundreds of billions, to come out of that Treasury General account, and that hasn't really happened. Could you walk us through a little bit more the details of why that hasn't happened, and if you think that spending will resume?
I think you've got two things really to think about here. You've got, number one, the effect of the debt ceiling, and the effect of the debt ceiling earlier on in the year probably took somewhere in the region of maybe $500 billion out of the Treasury General account. So the resolution of the debt ceiling will actually effectively put 500 billion back into the TGA. In other words, a big withdrawal from money markets. Now, somehow that has to go back in. Otherwise, markets will have to sink to a lower level or adjust to a lower level of liquidity. And that really means lower asset prices, higher repo rates, etc. And that's pretty much what we've been seeing in many ways. The other element you've got to throw in is the government shutdown. The government shutdown, brief or long or whatever, how one views it, basically took out probably another 120 billion. And that caused the TGA to go over $1 trillion, as you rightly say. Now, the fact that the government shutdown has now ended will mean that 120 goes back quite quickly into markets, which it is doing, and that's giving a little bit of a lift. But the real problem is we've still got that 500 billion or so, which came out because of the debt ceiling resolution. And it's that which needs to be addressed. Now, the target that the Treasury has is 850 for the TGA. Okay, so that's a little bit below where we are now, probably about 100 billion. So there may be a little bit more cash to go back in, but ultimately, what the current level of the TGA is telling us, or is what it means, is that banks have got significantly shorter reserves, because a big TGA takes money or liquidity out of money markets, and that is expressed, or the other side of that is that bank reserves are under pressure, downward pressure. So bank reserves have dropped by about 400 to 500 billion in the last few months, and that has really caused a problem in the repo markets. Now, if you want to look through the backdrop, let me just switch to a chart, which I can show you if you can put that up, which is looking at the liquidity collateral imbalance in the markets. Now, the reason for focusing on this is looking at the repo market. So this is the SOFR, which is system overnight funding rate, minus the interest on overnight reserve balances. So one is what the Fed sets, which is the IORB, and the other is what the market sets, which is SOFR. Now, you can see the market disagrees with the Fed here quite violently. And even though the Federal Reserve has managed to cut interest rates by 25 basis points, in fact, by the time this goes out, that'll probably cut again by another 25 basis points. But what the market is saying is they're virtually taking that 25 basis points away, because if you look at the spread versus IORB, it's of that magnitude of about 20, 25 basis points. So the market is basically saying we are very short of liquidity here, and the Fed needs to put some back in. Now, they've already taken a step towards that through stopping the quantitative tightening program. I mean, that's clearly a start. They also said that they're going to start reinvesting the mortgage-backed securities that roll off the Fed balance sheet, which they're continuing to roll off. So that's another form of cash that clearly could help here. And you've also got the possibility that the Federal Reserve starts or restarts some sort of asset purchases, and those asset purchases are likely to be very short-dated debt, probably Treasury bills. Now, how much are they talking about? Well, the sort of figures that are being bandied around are between about 20 billion and 40 billion per month, which adds up to something like 250, 450 billion dollars of extra cash through this year. That might the lower figure won't do it. The upper figure, the higher figure of 40 may do it. So I think this is really a benchmark that people have got to watch for. But I think you've got to put that in context, and the context is basically shown in the following couple of slides. This chart here is looking at the growth of Fed liquidity. Now, Fed liquidity is a fairly arcane construct, but it basically says that this is the amount of liquidity that the Federal Reserve is injecting into money markets. This is not the growth in the balance sheet. The balance sheet and liquidity are two very different concepts. Not all elements on the balance sheet create liquidity. So what you've got to do is to extract the liquidity creating or the liquidity sensitive elements and actually put them together, which is what we do here. And this shows basically the growth of what people really need to look at, which is Fed liquidity. Now, you can see back in 2021 that there was a huge expansion of the order of 80% plus at the peak. And then we saw a big tightening into 2022 when you see negative growth of 40%. Now, that seesaw or roller coaster was reflected in the performance of the S&P and many other risk assets. You then start to see around the back end of 22 a revival in Fed liquidity. That wasn't through direct QE purchases. It was through hidden mechanisms, what we flippantly called not QE. So this was things like changing the TGA, things like the reverse repo program, bank term funding program, operating losses of the Fed. All these elements were juicing the system with more liquidity. You can see the evolution of that. There's annotations we put on there. There was a liquidity air pocket we got basically around late 24. There was a surge at the beginning of 2025, which was the debt ceiling. And then you see the TGA rebuild that I've arrowed there, which has really occurred since mid-year. The grey area is the projection of what Fed liquidity is likely to do under the assumption that the Federal Reserve engages in, let's say, QE or reverse reserve management purchases of the order of about 20 billion per month. So adding about 250 billion.
So just to clarify, this orange line here on the chart for those listening is saying that in 2026 liquidity should go up, and that number is not just a placeholder. That is your forecasted path based on the best estimates we have from the Fed and guidance that we have right now of where liquidity, or Fed liquidity rather, should go in 2026. You expect it to increase from here.
Yeah, I think it's going to go. There's no question it's going to increase.
Right.
I think from here, I think the question we're debating is how much, and is it enough? Now, the issue that we raise is that it may not be enough. And the reason it may not be enough is shown on this following slide. Now, this is looking, if you like, at the other end of the pipeline. So the amount of money in money markets, in US money markets, is ultimately going to be reflected in the level of bank reserves. And the banks need a certain level of reserves to fulfill various criteria, such as things like the supplementary liquidity ratio, various other charges they've got. But ultimately, they are comfortable, or seem to be comfortable, with a level of reserves of around about 3.3 trillion. Now, that's the red dotted line on the chart. The orange line is the actual level of banks' reserves. Now, you can see that the orange line has fallen below that red dotted line projection, okay? Now, I see no reason why that red dotted line should change dramatically over the next 12 months, okay? Even given the various changes that the Fed has announced, such as changes to the SLR or whatever, I still think this is the sort of level that banks want. And we estimated that mathematically by looking at when you get stresses in the repo markets, and we basically felt that when the level of stress was eliminated, when there was no stress, that was the sort of level of reserves that the banks wanted. If the banks have deficient reserves, they've got to go out into the repo markets to bid for those reserves, or into the money markets to bid for those reserves. And that causes spikes in repo rates, as we've been seeing recently. Now, you can see the shortfall that we've currently got. The orange line has fallen well below the red dotted line. So as I said, we're around about 2.8, 2.9 trillion for US bank reserves. That's about 400 billion shy of where we should be. There is some lift off over coming months because, as I said, there is likely to be a restart of a QE form of policy, and there's obviously the ending of QT. The question is, will that be enough? And you can see from the diagram, our expectation is it won't be enough. Now, we may be dancing on the head of a pin here to say, well, okay, perhaps with a little bit more oomph, we could get back there. The real question is that what the Treasury or the Fed really want to do? And I think that's the sort of $64,000 question here. And everything that I detect coming out of the Treasury and the Fed is they're kind of reluctant to add a lot more liquidity because, in the words of Scott Bessent, I mean, Wall Street's had its day now. It's enjoyed the fruits of very loose Fed policy, or the Fed dishing out lots of liquidity, and now it should be Main Street's turn. And so what I see is actually more of a shift away from Fed QE, much more towards Treasury QE. And I think a lot of the policies that are being announced, such as even changes to the SLR, the fact you've got funding at the front end of the market, maybe even the stablecoin phenomenon, all these features are basically lending themselves towards what I would call Treasury QE. And that is a much more directed form of liquidity stimulus that basically goes into the real economy and not, generally or in an undirected way to financial markets, lifting all asset prices, but creating big wealth anomalies in the economy.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer.
Okay, let me try to synthesize this for our audience because I think this analysis has been very, very helpful and explains a lot of the market behavior we've seen in the last quarter that I think has confused many investors. So what I'm hearing you saying is that the TGA refill and the government shutdown caused an enormous amount of liquidity to be extracted from the economy. And now we're seeing the symptoms of that being this spike in rates, the lack of reserves and banks demanding more liquidity. The Federal Reserve is seeing that, is hearing it, and is responding to it. But you're saying they're deliberately responding in a measured way to try to prevent a crisis, but not rush to give all that liquidity back, because now you're saying this administration wants to favor Main Street, not Wall Street. So I want to kind of think ahead about what this looks like in 2026, because there's a number of questions that I have about this. The first one that I have is that in May of 2026, we'll have a new chairman of the Federal Reserve. Kevin Hassett seems to be the likely choice there. I want to get your thoughts on how this new chair might play into this, because obviously as we get into 2026, Scott Bessent, he will make a lot of these decisions. How do you think that changes the calculus in terms of what to expect from the Federal Reserve and their likelihood to meet the liquidity demands that we're seeing from the banking system right now?
Okay, well, I think the first thing to say is I don't think it's going to change it hugely, okay? Because we've got to remember that the FOMC is a committee, and he is one vote, and Stephen Miran likely will not be there by the time he takes over. So I think that these are all considerations that one's got to throw in. At the moment, what you've got in the FOMC, if you start to look at who's voting, or the constituency of voting members, you've really got sort of three groups as far as I can see. You've got the group of those people that argue that you need more liquidity in the system. Well, let's say they're the more technical balance sheet, gurus. I mean, people like Laurie Logan at Dallas Fed, who used to run the SOMA accounts. I mean, she knows what she's talking about when it comes to understanding liquidity, the repo markets, and whatever. And she's been one of the people that's been pressing, as far as I detect, for more liquidity to go into the system. Okay, that's a small group, right? And she's not a voting member of the FOMC yet, although I think she may be next year. Although or not to quote me on that, but I think she may be. But that's really a constituency that's there that clearly has a voice, certainly in the debate. The second group are the more conventional central bankers. That's people like John Williams at the New York Fed. Also Jay Powell, obviously chairman. They're much more conventional central bankers, and they're really thinking in terms of more traditional metrics. Thinking of what's happening to inflation. How should they be setting interest rates? Going back to the old sort of methodology of Taylor rules or wherever it may be. They're, if you like, the old school central banker, and they're the ones that have really been dragging their feet over easing policy I would say broadly over the last 12 months or so. And then you've got the Trumpites who have come in, and they're the ones who are very eager to cut interest rates. Now, I think the problem is that the baggage that they bring with them, and these are people like Governor Waller, I would put that, Michelle Bowman, also looking at Stephen Miran, but presumably the new Fed chair will be in that camp by all accounts, whoever he or she may be. But as you say, I mean, the odds are stacked anyway on one candidate. If you start to look at that grouping, they're saying they want much lower interest rates. I buy that, I understand that. But they're also saying they don't really want the balance sheet to expand very much. And that's a sort of anomaly that I can't quite get to grips with. But I think that's all consistent with this idea that you're moving from Fed QE, which is not a great thing in their mind, to Treasury QE, which is saying we're going to use the engine of the Treasury to stimulate the economy, and we're going to fund that through the bill market. And that's really, I think, the direction things are going in. So in my mind, if there is any push from Kevin Haslett, it will be much more along the lines of saying we need to get interest rates down quickly, okay, because that will help the real economy. It will help small businesses. It will give a signal to the forex markets, importantly, that we want the dollar to go down. It may help to get mortgage rates down. So all these factors are, I think, in their sights when it comes to trying to understand the policy direction. But I don't think necessarily keeping the Fed balance sheet bloated or high is on that agenda. Now, that clearly runs a risk, but it means that this is a policy, or the Fed policy that they're likely to run is not really a policy, in my view, that will sustain a strong bull market. I'm not going to say it's one that creates a bear market, but it's not one that really engenders a strong bull market. And that's really, I think, the concern. It may well be a policy, or it may well be a strategy that is good for the real economy. And actually, I'm pretty upbeat on the US economy for next year. I don't know, the consensus, I think, is still pretty downbeat, but I think things look pretty good. One is you've got a lot of fiscal spending going on. That doesn't seem to be ending. It's being easily funded through the bill market. The banks are effectively monetizing it. And what you've got on top of that is huge AI spend. So that to me would suggest the economy is going to do okay. The real risk, I think, next year is an inflation risk. So actually what you could be seeing is pressure on the Fed in the second half year to actually rethink the idea that they want interest rates a lot lower, or even to say, what role do interest rates play in the equation these days? And that actually is the deeper head scratching question. Are interest rates always are they fulfilling the role they should fulfill in a world where you've got a government which is transferring huge income transfers to the private sector and interest payments? If you cut interest rates, you're actually reducing the private sector's income. So is that a tightening of policy or an easing of policy? Difficult to say.
It's a really interesting observation. Yeah, I feel like all the definitions of these things keep changing. Like, what is QE? What is not QE? And there's a moving target on all these things. But effectively, they're doing the same thing, just under different names. I want to kind of zero in a little bit more on this idea that you have that this new path, that the policy path that the Trump administration is pursuing, will be more stimulative for the actual economy as opposed to markets. Could you just explain a little bit of specifically why you expect that to be the case, and who benefits the most in terms of I guess who benefits the most from that different policy path there?
Well, let's look at the risks first. So if you look at the slide that I put up here, which is looking at which actually goes back to this slide, and if you measure the gap between the orange line and the red dotted line, you actually get the orange line on this chart, which is the level of excess or deficient reserves among US banks. And what I've put on top of that is the number of trade fails that you see within the system in terms of primary dealers' trade fails in the markets. Now, what that really means is a failure to deliver securities, and it could mean a failure to deliver securities, I should say. And it's obviously not a good thing. So if you start seeing a lot of transactions that are failing, what you're likely to see is heightened volatility in the markets. And if you get heightened volatility in the bond market, you may well threaten this basis trade that's been going on with hedge funds, which has been hugely supportive of the Treasury market through this year and actually into last year as well. So that's a big danger, not least because the Federal Reserve's own estimates would suggest that hedge funds have been responsible or were responsible last year for buying about $1.5 trillion worth of US government bonds. Now, out of a $2 trillion deficit, that's clearly a large amount. That's point number one. Point number two is, what about the S&P? So this is looking at a plot of Fed liquidity in red. So this is the estimate that we put together, which is basically looking at the liquidity creating elements of the balance sheet. And this is an absolute dollars. So you see on the right-hand scale, this is hovering around three and a bit trillion. That's the red line. That's the projection we make into 26 based on all the evidence that I just gave you. The orange line is the S&P. Now, if you look back, and what I've done actually, I should stress here, is that the S&P has been lagged by 25 weeks to show that liquidity is a key leading indicator. It doesn't get every twist and turn in the markets, but if you just look back, often where you get big air pockets in Fed liquidity, the market comes off, and it's a lead indicator because you've got that 6-month lead time. Now, what this is saying right now is that the fall in the red line that you've had, which is the TGA rebuild, is ominous when it comes to looking at what the S&P may be doing. And that's one of the reasons that we're, let's say, cautious about markets right now, because you've actually seen this absolute fall in Fed liquidity, and historically that's not good, okay? And okay, it's going to rise next year, but this is a little bit of a belly flop when it comes to looking at the potential for 26. You're not really rebounding very strongly to where we came from, and that's really the danger. If you look at the following slide, what that basically shows is Fed and Treasury stimulus. Now, this is looking at all forms of liquidity stimulus, and this highlights the fact that what we've got on the page is a diminishing Fed component and a rising Treasury component. Now, let me just walk through those various elements. The red area on the chart, so this is the amount of liquidity stimulus, and I'll explain in a little bit more detail how we get the Treasury one. But the red is straightforward QE by the Fed. So that's old-fashioned, plain vanilla QE. The Fed is buying bonds, right? The orange element is what I called and mentioned earlier is not QE. That is the backdoor channels. So this is things like the Bank Term Funding Program. It's things like changes in the RRP, the TGA, operating losses of the Fed, etc. Everything put together in that orange band. And then the Treasury QE is basically the black area. Now, what that measures is the effect of changes in the duration, in other words, the average maturity, let's say, of the outstanding stock of debt held by the private sector. And the reason for looking at this is that if you think conceptually about liquidity, what liquidity is the size of an asset pool divided by its average duration. Now, that sounds a bit wonkish, but if you think about it, that's broadly what liquidity is. So you can get an increase in liquidity if you increase the amount of assets in the system, or if you reduce the duration of those assets. And that's effectively what the Treasury is doing by doing a lot of spending through the bill markets. So bills are clearly very, very short-dated debt. And if they're not issuing 10, 20, 30-year treasuries, but they're actually issuing 3-month bills, then there's a complete change in the average maturity of the debt structure of the US government. And that is starving the private sector of duration, but it means that there's more liquidity in the system notionally. And that's the black area. So what you see here is the big increase in Treasury bill issuance is actually causes like a liquidity injection. And you can look at it another way and say, well, that's actually the banks are monetizing that. But, effectively, we've got this liquidity shot in the arm coming from the Treasury. The difference between Fed QE and Treasury QE is that Fed QE is undirected Okay, it's just thrown into the money markets or the financial markets, and asset prices find their level, and you hope that you get some spillover into the real economy, although clearly that's not guaranteed. Whereas with Treasury QE, it's much more directed. Now, what I tried to show is that if you look historically on that little window, the black line is the change in the US PMI, the aggregate PMI, over 12 months. And I've lagged that by 9 months. And I've plotted it on top of this combined stimulus, the same graph, in fact, you see there. Now, what you can see is that the liquidity stimulus pretty much traces out the business cycle. So, if anyone's concerned about a dip in the economy right now, you could argue it was kind of expected because that the liquidity stimulus came off last year, and therefore you'd expect some sort of dip following in 25, which maybe we're getting. But as you look at that orange line, it's ramping up again, and that would suggest that the economy is going to be stronger in 2026. That's how that would be our assessment, at least, and that's the impact of Treasury.
This is the biggest year ahead for crypto, AI, and the macro, but the real moves aren't in predictions. Join Milk Road Pro today to see our live portfolio, buy-sell signals, and the AI investing portfolio, which launches in January. The link is below.
Yeah, so this is, I would like to unpack this a little bit more too, because the last time you were on the show, I asked you this question. You said that, the ISM hadn't shown the traditional business cycles, and you said there's a possibility that may not come back. And this is something that we at Milk Road Macro have been watching closely too, is this movement in the ISM. What I'm seeing here is that you're forecasting that the ISM should pick up in 2026, which would reflect a bullish momentum from the actual economy. But then I'm also hearing you saying, like in the prior slide, that you're expecting that asset prices may not follow that bullish momentum. And I would like to hear your thoughts on, do you think that's a proper assessment of your forecast, that divergence, or what am I missing there?
I think it's absolutely. I think that's right. Strong economies don't always have strong financial markets. And the fact is that, you think of it this way, all money that is anywhere must be somewhere. If it's in the financial markets, it's not in the real economy. And if it's in the real economy, it's not in the financial markets. Unless, of course, the Federal Reserve is just pumping money willy-nilly, and we know it's not.
All right, let me ask you another question about this, because I think this is a really interesting thing. Where they are putting this money, right, is into economic activity. That economic activity is centered around investment in artificial intelligence. In theory, and Elon Musk just did an interview talking about this recently, but in theory, as AI improves and advances, that should have some level of a deflationary impact, because if the amount and quality of goods and services that AI is able to create increases and the monetary supply is kind of held the same, in theory that should have a deflationary effect, and that might help dampen some of this worries about inflation. Do you have a view on that at all? Does that make sense? Do you disagree with that view at all?
Well, I think it's a point well taken. I acknowledge exactly what you say there, John. But I mean, the issue is that if you look at inflation, you've got two components. You've got in terms of high street inflation. High street inflation is a cocktail between cost inflation or cost deflation and monetary inflation or monetary deflation. So you've got two moving parts. And you can get high street prices rising because you get cost inflation. That could be, let's say higher oil prices, nothing to do with monetary phenomenon. But clearly if oil prices go up or wages go up without a productivity increase, in other words, unit labor costs go up, then you're going to get costs on the high street going up or main street prices going up. Okay. So you've got this divergence between Wall Street and Main Street again, in this context. Wall Street tends to get all its impetus from monetary inflation. In other words, the Federal Reserve printing money. It's not really too affected by cost inflation. Maybe it's, it's only in the same way. So actually, Wall Street prices may go down if you get cost inflation, for example, but they will go up if you get monetary inflation. So there's a different reaction. Now, if you look forward, what you've got is the potential for AI to reduce costs. I mean, I accept that. I don't know how big or small that will be, but then I've got to offset that with the fact that you probably won't get cheap Chinese goods. You may even get more expensive Chinese goods. But we've just had a decade or more where Main Street has been flattered with very, very cheap Chinese products. That's not going to come back again. But that really enabled the luxury for the last decade for the Federal Reserve to undertake significant monetary inflation, which inflated Wall Street, but Chinese cost deflation and various other things. I mean, obviously, technology improvements from the US, from US industry as well, basically meant that costs were deflating. So mix those two things in the cocktail: higher monetary inflation plus cost deflation. The high street or main street prices don't change very much, and that's what we saw. Now, what you've got is an environment where monetary inflation is probably continuing, okay, and I'll come on to that in a moment. It may not be monetary inflation for Wall Street, but it's monetary inflation generally in the economy as the government is printing money. And what you've got at the same time is maybe some uncertainty over costs. You know, what's going to happen to oil prices? Are oil prices going to go up? They're quite depressed at the moment. They could go up. That would be a negative. You could get mortgage rates or interest rates which come down. That could be a positive. You're not going to get cheap Chinese goods. That's clearly a negative. But you may get AI. That's clearly a positive. So you've got these factors to weigh out. So I'm not too clear what the cost elements will be, but I'm pretty sure that the monetary element will be positive. And that's why I think you've got Main Street inflation accelerating.
Gotcha. I see what you mean. There's multiple inputs to inflation. Some are unknown, but the ones that are known are going in a clear direction. One more question on this before I let you continue. We talked about this divergence in your expectations between strength for the economy and maybe weakness for financial markets. Do you still think that, we're going into this midterm year, the Trump administration wants to perform well? They're not just going to let the S&P 500 belly flop and not do anything. Do you think that the fact that we're going into a midterm election year means that the Trump administration is maybe more likely to pivot a little bit on this and give some relief to Wall Street at the expense of Main Street? Or like, what's your thoughts on the calculus there?
Well, I think Main Street is the focus by far. And whether it means that they want the dollar lower, I mean, that's the agenda I see there for sure. And I think the issue is the dollar has been stronger maybe than the administration want this year because so much money has actually come back into US markets. And there was this sort of, rather crazy idea at the beginning of 2025, which was sort of perpetrated by, journalists, the media, I hesitate to say the mainstream media, but it was the mainstream media, things like the Financial Times, that this huge amount of money was leaving America. I mean, that just wasn't the case, okay? In actual fact, the dollar has been lately quite robust, and that's because money has been coming into the US. A lot of the reason for dollar weakness at the beginning of the year, there was much more hedging activity rather than wholesale, investors quitting the US market. And I think the problem the administration has got is actually to hold the dollar down. Now, the best thing they can do if they want the dollar lower is to accelerate interest rate cuts. The problem with doing that is it somewhat smacks against this risk of higher inflation. And that's why there's a dilemma or a very difficult path for the Federal Reserve or the new Federal Reserve to try and tread next year. And
but it would help. It would help asset markets, though, right?
Yeah, no, there's no question. I mean, there's no question that a weaker dollar would be positive for asset markets generally. But I mean, you've got to think about this much more in the context that this is potentially monetary inflation. And if you look at, for example, the chart I've just put up there, I mean, this is a warning which is saying, this is the way the world is unfolding here, is that the red line is traditional M2 money supply, and the orange line is the growth of Treasury and agency securities held by banks. And that sounds a bit of a wonkish statement, but it basically, in a word, is saying that's the amount of, that's the growth, if you like, in credit to the US government. In other words, overall credit growth is being dominated by the government. The government is driving, if you like, monetary growth higher because of what it's borrowing, and it's okay, except it's indirect borrowing. I mean, they're basically issuing bills and bonds, and the banks are buying them. But the banks are actually funding this through expanding their balance sheets. And the reason that this is very different from the conventional sort of way of understanding it is that if a pension fund or a life insurance fund, or a retail investor buys a government security, they're doing it out of their existing savings, okay? If you've got a situation whereby the banks are buying government securities, they're not doing it from savings, they're expanding their balance sheets to do it. That is monetization. And that's really the big risk that we run, because we know that monetization doesn't end well. Now, if my maths are correct in this, if you look into 2026 and you look at what the administration are, I think, anticipating the Fed and the banks' appetite for treasuries to be, we could be thinking of a situation where something like half the deficit is being funded, or let's say, to be prudent, 40% of the deficit is being funded by the banking system. In other words, collectively, the Fed and the banking system. Now, that's not even including stable coin issuers, which is another element. But you get the idea that what's happening here is that credit providers are being leaned on heavily to try and finance the deficit. The problem is not just the size of the deficit, but the fact that it's being funded very much at the short end, which are the sort of securities these entities really like. And that's, the Treasury is offering them for the simple reason that it's trying to encourage funding or easy funding for itself. The problem is that doesn't end well. We know that. It's monetization. And if you want to protect against monetization, you've got to buy monetary inflation hedges. Monetary inflation hedges are things like gold, silver, Bitcoin, probably generally crypto, things like prime residential real estate, things like good quality American companies that have got pricing power. All these things tend to benefit, or at least perform relatively better in these monetary inflation environments. And I think the environment, looking forward, is one where you could easily see traditional M2 growth in the US up in sort of high single digits next year, somewhere of the order of maybe 7-8%, which clearly is a long, long way distant from a 2% Fed inflation target. And that's the anomaly.
And so what I'm hearing you say is buy Bitcoin. So I'm just going to leave it at that. Michael, every time I talk to you, I feel like I learn a lot. I get lots more insight than I get from other people. And I feel like we could go for hours and never run out of questions. I didn't get to ask about China or other things, but I kind of want to land the plane a little bit here on this because we're getting towards time. A lot of people who watch this channel are investors, which means they're very interested in asset markets. And last time you were on our channel, you said your forecasted peak for liquidity was Q1-ish of 2026. I want to get your thoughts on, has that changed? And obviously that doesn't coincide with a peak in a market or a bull run, but which side are you on that? Because I've heard you say recently you're not bullish, not bearish, but you're kind of cautiously neutral. And just kind of give us your thoughts on this. Where is the peak in liquidity in your mind coming? And what does that mean for asset markets? And just how are you thinking through that?
Okay, well, look, first question is there a peak in the liquidity cycle? So if you look at the chart that I just put up, this is the long-term liquidity cycle. This is an index of global liquidity, is an index of the momentum of liquidity. So what it's showing is the growth rates. And what that is telling us is that the liquidity cycle here is dipping down. In other words, it's losing momentum. It is not falling in absolute terms. I mean, let's be 100% clear here. You're not getting absolute falls in the level of liquidity, but what you are getting is a slowing in growth, and markets often price at the margin. So in other words, that if you start to see a lot of momentum, it's not good news, okay? And that's what we seem to be saying. Now, it's entirely possible that black line picks up again. That could happen. I mean, if you look back at the chart, you can see that has happened before. But we're basing everything we do on data. So this is a very data-intensive exercise. We're gathering data from 90 countries worldwide, and we look at about 30 data series per country. So there's an awful lot of data which is basically dumped into this graph to actually get the line. And what it shows is a sine wave that we put on top that fluctuates with a 5 to 6 year cycle. And that 5 to 6 year cycle is what we referred to before as the refinancing cycle. And that's simply because financial markets today are all about debt refinancing, not about new capital, not about financing new capital. Those days have long gone. And so what you've got here is it seems as if that liquidity cycle is peaking. Now, if you look at it in terms of context, this is the current cycle in red against the average cycle from 1970 to 2025, okay? The zero on the bottom axis is the low point of the cycle. So I've aligned the two. And you can see that this cycle is not a million miles different from what we've seen in an average cycle. Now, the fact that the cycle is turning down does not necessarily mean we're going to get a bear market. I think it would have to turn down very sharply for that to happen. But if I go on to this chart, it's basically illustrating that this is the growth rate of global liquidity, as you can see in orange. We've extrapolated what we think is going to happen next year. And let me stress again that this is not an absolute fall. This is still seeing positive growth. So we're constructive. It may be that the US is no longer the main driver of that liquidity cycle. It may be other countries. You cited China, possibly Europe, Japan, all these are possible contributors. But the liquidity cycle clearly slows. And if you look at the black line, that is the returns on a portfolio of all assets, in other words, all wealth worldwide. So it's things like equities, bond markets, liquid assets, the returns on all those, prime residential real estate, crypto markets, precious metals, everything is in there. And that portfolio, that's the average return you get on that portfolio. Now, it would signal that we're rolling over. In other words, the returns, we're past the best in returns, still get positive returns, probably next year, but we've got to be, cognizant that we're at around an inflection point, and inflection points can be dangerous. Now, if I'm going to say one last word on that, it's just to say this, and that is that this is the asset allocation cycle, and this is what you've got to start thinking about in terms of how the world is unfolding. This is the cycle, and cycles and trends go together. I haven't really spoken about the trend, but my view is that the trend in liquidity is definitively upwards over the medium term, because liquidity and debt go together, and debt we know is exploding because that's the nature of sort of modern governments. I mean, they spend money and they finance it through debt, and ultimately liquidity has to keep pace with that debt. So the trend is upwards. That's monetary inflation. That's why you need monetary inflation hedges like Bitcoin, gold, silver, etc. You know the list. This is the cycle on top of that. Where are we in the cycle? In the US markets, we're in the speculation phase. In the Asian markets and in Europe, we're in late calm phase. So we're around the peak of that cycle. And if you look to the right-hand side, you'll see the asset allocation implications, which are telling us that you want to be around the commodity area. Okay, equities is getting late, cash is probably too early, commodities look decent, but that's real assets. Now, what is Bitcoin? I think Bitcoin, if you ask me, is 2/3 a commodity like gold or silver, and 1/3 a high-tech stock like NASDAQ. Now, we can debate the division, but it will be something like that. So it's got characteristics of both. And that means it's more volatile than many other instruments because it's got that tech element in it. But nonetheless, it should, over the long term, move with gold or move with silver and probably outpace them because of the take-up effect. It's still a very nascent asset class. Now, if you look at these traffic lights, this is just telling you how the cycle evolves. Now, what I said to you, I think, in the last interview is that there's been virtually no business cycle, in other words, economic cycle, since the end of COVID. Everything has flatlined. But there has been definitively a liquidity cycle, and quite a pronounced one, and an investment cycle which has moved pari passu with that liquidity cycle. Now, if you look at the cycle, the investment cycle, you can see how it's unfolded according to these traffic lights. And this is just a standard benchmark interpretation, but it's been absolutely, on the money in terms of how this cycle has unfolded. It's been a very normal cycle. In other words, look at the rebound area, which began in late 2022. That would say you want to think of it as a traffic light. Amber, proceed cautiously, but go forwards. Green, go. Red, stop. In the rebound, you wanted equities and credits, so you wanted to have a bit of risk exposure. You didn't want commodities or bond duration. By calm, you wanted more full-on risk. You wanted equities. you probably were starting to be a little bit cautious of credits and you wanted more exposure to commodities. Speculation where we are now, you want commodities. You're starting to get out of your credits. You're beginning to pare down your equity exposure extremes in the speculation phase, and you're kind of getting ready for maybe bonds potentially performing. But I'd say you probably want to be thinking about mid-duration bonds initially on that. Look at the industry groups, exactly the same phenomena. Technology is led, did this time. Financials performed strongly mid-cycle, they did this time. Energy commodities coming through late in the cycle. Think of mining stocks this year, etc. Again, very strong. Energy probably, that could be the next area to pick up, but worth thinking about how these timelines move. And then defensives, so stable, consumer staples are the sort of things that would perform relatively better during a defensive phase in speculation or turbulence. And that's broadly how things are evolving. So what you can see from here is we like the trend. The trend is great. It's up, but we've got to be wary of the cycle. And at this stage, the cycle is probably beginning to dip. So message is buy on weakness. And if you can buy Bitcoin 20% below the trend, that's not bad.
Right. So it's late, it's mature in the cycle, but it's not over. So look for buying on weakness. And then, like you said, like you're not full on outright bullish on everything, but you're not gone bearish either. So it's a great time to just watch and wait and see how 2026 develops from here. Michael, this has been really great. Like I said, we're at time, so I'm going to end it there. But I learned so much every time, and there's always more to discuss than we have time for. So thanks so much for coming back on Milk Road Macro. Where can we send people to find more of you and your work online?
The best place is to go to Capital Wars, which is the Substack. But you can find us in terms of if you want data, institutional services, or whatever. That's glindexes.com.
Michael Howell, the godfather of global liquidity. I hope you stay wet, and I hope I see you again soon on Milk Road Macro.
Great. Thanks. Enjoyed it.
Thank you. And thank you all for joining us. We hope you all learned something today. So until next time, stay safe, stay educated, Merry Christmas, and we will see you all on the next episode of Milk Road Macro. Thanks for joining us, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.